Welcome back to Money Talks, your guide to the Canadian securities. I'm your host, Rita, and it's fantastic to have you with us again. Before we jump in, I just want to say a huge thank you to everyone who's been listening and supporting the show. If you're enjoying the episodes, please take a moment to subscribe, like, or even leave a comment. And if you know someone who could benefit from this, please share it with them. It really helps us a lot in bringing this content to you every week. We're also working on an exciting new project behind the scenes to make this podcast even better, and we'll be sharing some news with you very soon. Now, speaking of great content, I'm thrilled to have our resident financial expert, Veeral Kotak, back in the studio. Hey, Veeral, great to have you once again. How's everything going?
Everything's great, Rita. Always a pleasure to be here. The markets are keeping us on our toes, as usual, but that's what makes it interesting.
I can imagine. Well, that actually leads us perfectly into our topic today. We often hear about picking the hot new stock, but you've always said that successful investing isn't about finding one perfect needle in a haystack. It's about building the whole haystack. So today, I want you to talk about the importance of the introduction to portfolio approach. Why is this concept so foundational for any investor?
That's a fantastic starting point, Rita. And you're right. The idea of a single perfect security is a myth. If it existed, my job would be a lot easier. At its core, the portfolio approach is about a simple, powerful idea: diversification. It's the age-old wisdom of not putting all your eggs in one basket. By creating a diversified portfolio, you can reduce your overall risk without necessarily sacrificing your expected return.
Okay, diversification is a word we hear all the time, but what does that actually look like in practice?
Imagine you're building a championship hockey team. You wouldn't just sign 20-star goal scorers, right? You'd be unstoppable on offense, but would lose every game 10-8. You need defensemen, a goalie, and players who are good at face-offs. Each player has a different role. A portfolio is the same. You might have Government of Canada bonds that act like your steady goalie, providing reliable interest income. Then you have some common shares, maybe from a big Canadian bank, that are like your star forwards. They have the potential for big growth through capital gains. Each investment plays a different role, and together they make the team stronger and more resilient.
I love that analogy. A balanced team, not just a team of superstars. So this all comes down to that fundamental tug of war in investing: risk and return. How does the portfolio approach help manage that?
Exactly. Risk and return are two sides of the same coin. The rule is simple. To get higher potential returns, you must accept higher risk. To avoid risk, you have to accept lower returns. Think of it like transportation. Walking is very low risk, but it's slow. That's like a GIC. Driving a family car is moderate risk and gets you there faster. A Formula One race car offers incredible speed or potential return, but the risk is high sky. An investor's job with their advisor is to decide what kind of vehicle suits their journey and their comfort level with risk.
So when we talk about risk, it's not just one thing, right? The text you shared mentioned different types. What are the big ones we need to know?
That's a critical point. We can split risk into two main categories. First, there's systematic risk, also known as market risk. Think of this like the weather. When a big storm hits, it affects the entire ocean. Almost all boats are going to be tossed around. Systematic risk is like that. It's inflation, a rise in interest rates, or a recession. These are broad economic factors that affect the entire market. You cannot diversify this risk away. It's the price of admission for investing.
So that's the risk you just have to accept. What's the other kind?
The other is non-systematic risk or specific risk. This is the risk of your specific boat having engine trouble. For example, a company you invested in has a product recall or their CEO gets into a scandal. This risk is specific to that one company or industry. And this is the risk you can dramatically reduce through diversification. If you own 20 different stocks in different industries, one company's engine trouble won't sink your entire fleet.
That makes perfect sense. You can't control the weather, but you can make sure you have more than one boat in the water. Veeral, that's such a brilliant way to explain it. I have to pause for a second here. For everyone listening, if you're finding these analogies as helpful as I am, this is a great time to hit that subscribe button so you don't miss future episodes. Sharing this episode with a friend who's just starting their investment journey would also be a huge help. Okay, sorry for the interruption. So, when building this fleet, how do you choose which boats to add? Is it just about picking different industries?
It's a bit more scientific than that. The key concept here is correlation. It's a fancy word for how two investments move in relation to each other. Imagine you own stock in two of Canada's big banks, say RBC and TD. They're in the same industry, affected by the same interest rate policies. When one does well, the other usually does too. They have a high positive correlation. Adding both doesn't give you much diversification. But now, picture this. You own shares in an airline, like Air Canada, and also a discount bus line. When the economy is booming and people feel wealthy, they fly. Air Canada's stock might do great, but in a recession, people tighten their belts and take the bus. The bus line stock might go up while the airlines goes down. They have a low or even negative correlation.
So you're looking for the investment equivalent of an umbrella seller and an ice cream vendor. Their success depends on opposite conditions.
Precisely. Finding perfect negative correlation is the holy grail, but it's rare. The goal is simply to combine assets that don't all move in perfect lockstep. That's how you smooth out the ride.
Okay, so let's say we've built this diversified portfolio. Is it set it and forget it, or does someone need to be steering the ship? This brings us to portfolio management styles.
Right, and this is a big question for investors. There are two main philosophies here, passive and active management. Passive management is like taking the city bus. The route is already set. It's designed to follow a major market index like the S&P TSX Composite Index in Canada. The goal isn't to beat the market, it's to be the market. This is often done through index funds or ETFs. It's low cost, straightforward, and you'll get the average market return.
Simple and efficient. What about the other side?
Active management is like driving your own high-performance car. The manager believes they can find shortcuts, beat the traffic, and get to the destination faster than the city bus. They are actively researching, buying, and selling securities to try and outperform the market. This requires more skill, more research, and usually comes with higher fees.
So for listeners thinking about their own investments or mutual funds, what kind of drivers are out there in the active management world?
Within active management, there are many styles, but two of the most common are growth and value investing. A growth manager is looking for those race cars. They're focused on companies with rapidly growing earnings, the next big thing. They're willing to pay a premium for a stock today because they believe its future growth will make it a bargain tomorrow. Think of innovative tech companies. It can be a thrilling ride, but also more volatile.
And the alternative?
A value manager is a bargain hunter. They're sifting through the used car lot, looking for a solid, reliable vehicle that's just overlooked or out of favor. They look for fundamentally strong companies that are trading for less than they believe they're worth. It's a more patient approach, often with less volatility, waiting for the market to realize the hidden value.
So as an investor, you need to decide if you want a manager who's chasing the next superstar or one who's finding those hidden gems. That's a powerful distinction. Veeral, this has been an incredibly clear breakdown. We've gone from why we need a portfolio to understanding risk to how to combine investments, and finally, who's driving. What's the one key takeaway you want our listeners to walk away with?
The most important thing to remember is that there is no single best portfolio, only the best portfolio for you. It has to be built around your personal goals, your time horizon, and your comfort with risk. The portfolio approach isn't about finding a magic formula, it's about building a robust, resilient strategy that lets you sleep at night while your money works towards your future.
Build a team, not just a superstar. A fantastic piece of advice. Veeral Kotak, thank you so much for breaking down the portfolio approach for us.
My pleasure, Rita. Anytime.
And that's all the time we have for today on Money Talks. A huge thank you to our guest, Veeral Kotak. Join us next week as we dive into how to put these principles into practice with asset allocation. Until then, stay smart with your money.